High yield has been a hot asset class since the Fed decided to keep yields at rock bottom levels. But are junk bonds in bubble territory? Joining me to answer that question is Gershon Distenfeld from Alliance Bernstein. Tell me, Gershon, is this a bubble? Because a lot of people are buying junk.
I think people are confusing a market that may be a bit expensive with that of a bubble. If you study the history of bubbles, you see the similarities between them, you'll right away realize that high yield and bubble shouldn't even be uttered in the same sentence. There have been many bubbles, from the famous tulip bubble, Dutch tulip bubble of 1637, to more recent times, internet stocks in the late 90s, housing bubble the past decade or so. And the common theme among all those is people thought they were going to get rich, right? The greater fool theory. I'm going to buy something today because someone's going to buy it for me at a much higher price sometime in the future. And when that happens, the price of the asset gets completely divorced from any inherent economic value. Let's look at high yield bonds. No one is buying high yield bonds today because they think they're going to get rich. In fact, quite the opposite. They need income, and income is very scarce. But secondly, and perhaps most importantly, there is an inherent value in a high yield bond, right? It's a contract between a company and an investor. The company either can default on their obligations or they can pay you back. Most of the time they pay you back. So if you don't think there's a lot of defaults coming up, there's no way high yield's a bubble.
But default rates are really at lows right now, about 2 to 3%, and yields are also low. You're talking about on the J and K around 6.5%. So at least in terms of the pricing, seems awfully pricey.
It is a little pricey, and we should not expect the same kind of returns we've had over the past 3 or 4 years. We're starting at much lower levels of yield. So if we're starting at 6.5%, in any one year, it could be more or less. But over like rolling 3 or 5 year periods, you pretty much earn your yield. That's because you have a yield, you lose from defaults, and you make up for it when positive things happen and companies get, the debt gets taken out at higher levels.
So which sectors in high yield are you seeing the best returns? Is it casinos? Is it airlines? Where are the best sectors right now?
So, high yield investing is very different than equity investing, and that it's much more important to talk about what you don't own. Again, not trying to get rich. A good outcome for me is I get paid my interest income and I get my money back at the end of the day. So I think the important thing is, and we're seeing this across sectors, is at this point in the cycle, you don't want to stretch for that extra yield, right? If the average yield is 6.5%, the stuff coming with 7.5%, 8% yield has a much higher default probability and is not likely to compensate you enough for that extra yield.
Default rates, yield. The other big thing about high yield is issuance. Are you seeing a lot of issuers come to market? Because supply and demand, very important.
Yeah, we are seeing a very fair amount of issuance. Last year was a record. This year might be very close to that. But more important than the level of issuance is the quality of issuance, right? Most of the issuance over the past 2 or 3 years has been to refinance existing debt, right? Which gives companies a leeway in case we have economic volatility. They're not up against a wall to finance themselves. At this stage of the cycle, what you have to watch out for is some of these leverage transactions, LBOs, companies actually borrowing money to spend on CapEx, because that does lead to more defaults down the road.
All right, we're not in bubble territory, says Gershon Distenfeld. Thanks for coming on.
Thanks a lot for having me.
Thank you for watching The Street.